Mr. Ademola, a very, well, mixed picture that Mr. Abe has actually painted. Investment opportunities are actually staring us now in the face.
Yeah.
As grim as it looks, but there are investment opportunities.
I don't even think there's anything that is grim there. The fact remains that the action of the MPC is appropriate at this moment. There's nothing anybody can do about that. Now, the thing is that over the number of years, maybe like the last 6-5 years, we have depended so much on foreign portfolio investors rather than FDI that we were depending on when we just led into democracy. The reason why we were able to build up a lot of foreign reserve and have good buffer then was because our reforms, local reforms, was bringing FDI rather than FPI. But lately, the fiscal authority seems to have gone back in terms of reforms and moving things forward to be attracting FDI, rather than we are using monetary policy to attract FPI, and that's what has happened now. Those FPI, they call them hot monies, because the money goes to where they can get good returns on their investment. Risk return, they find out that they are better off staying in the US, the economy that is improving, rather than staying in Nigeria. So we need to make sure that we attract them back, and that's what we have done now. We have devalued the currency. Let me say, I'll use depreciation. We have depreciated the currency, right, up to where we are now, which make it now more attractive for someone that is just coming into Nigeria. Those that are in Nigeria currently, they're already stuck, because now they have about 8.4% loss on currency return, and they have to make sure that the asset return grow up to be able to cover that for them before they can be okay to go back. But those that are coming in now, they are now bringing lower dollar for an equivalent naira, or the equivalent dollar for more naira, which can make them to buy more assets. So opportunity are bound for us. Now, in the fixed income market, there's tendency that the yield is going to increase with normal. The banks are likely going to sell down if they don't have the cash for the CBN to pull out. So what we find out is that, like Mr. Abis talk about inflation possibility from the depreciation exchange rate, that's quite very possible because of the high import content. The food inflation, imported food inflation, about 13% of our total inflation basket. So that going up can affect inflation. However, the monetary policy committee to understand that, and that's why they have tightened the other side, saying that we know the inflation that come from here, and then we are reducing liquidity from that part.
Yeah,
so, okay, go ahead.
No, sorry to continue.
We are using liquidity tightening to curb that. Now, like you said, it curb demand. What happens is that you don't even have the liquidity to be able to afford the now expensive imported good. So you are likely going to have to be forced to use substitute. Maybe this is a good time for us to see the cassava bread. This is the good time now to see the rice that is locally made, and people probably substitute that for that. It's a normal phenomenon. You mentioned about medical tourism and even holiday tourism. It may a little bit reduce. People have to rejig and jog, because again, it has been argued before that the kind of pressure of demand from the kind of medical tourism, education abroad, and travel to for holiday is actually substantial when it comes to the demand for on foreign currency.
So investment opportunities actually staying everywhere.
I mean, as it is right now, in fact, our expectation is that maybe a lot of people will quickly run away from the equity market. But hey, bargain hunters are looking at it and say, wait a minute, the market seems to be already rock bottom anyway. Let's move in. And it appears that in Nigeria, there's delineation between the equity investors and the fixed income investors. So unlike other countries where you see people quickly leaving the equity market to go to the fixed income market because the yield is now very important, the most important thing is that in both markets, equity, fixed income, there is great opportunity. Yield is increasing in the fixed income market if you are that kind of investor, and prices are quite low on the equity market as well. So you can take opportunity to do it. It will come down. And again, another thing that Mr. Abe did not mention is the fact that what we are expecting to moderate the foreign exchange pressure is that this attractive opportunity will bring these hot monies back. Because those guys will now price and look at it, okay, now this is the risk, this is the return. I think it's better off now for me to come back. So a lot of them will return to come back. Because what they'll be expecting is that the exchange rate will be depreciated and it will affect their return. So let me quickly go.
Yeah, but then you see, a lot of people are actually wondering now that with this depreciation, like you call it, is it realistic, the band that the Central Bank of Nigeria has actually set it at 160, especially plus or minus 5, especially with the drop we've seen in oil prices. OPEC is meeting today, and there isn't a possibility that there's going to be a cut in production. Saudi Arabia is definitely going to take a strong stance and insist that there's no need to cut. Venezuela is actually pushing for cuts. Nigeria too is
what I would say is that Nigeria has never honored any cut in production before in oil price. So we shouldn't bother ourselves with all these kind of words. That's the truth that I want to say. Another thing is that the reason why Saudi Arabia, the largest exporter of oil, is saying no is because it appears as if what they are trying to do is to do price war, to be able to discourage glut that is impending. Because if the fracking, the shale oil that is going in the U.S. is, for example, in this year already, it's estimated about 1.2 million barrels per day is being exported from the U.S. or is available from the U.S. that can go in. Whereas global demand has increased by only now 60,000 barrels per day, which means already from just U.S. and everything, we have about 200-something thousand barrels per day excess capacity.
So now out of that,
but again, the thing is that fracking, I mean, the shale oil is quite expensive compared to natural oil that we're selling. So there's a price in which it becomes not profitable for US to start exporting. So what you see these oil people are probably trying to do is bring the oil price down to where it will not be profitable for shale oil to come again, and then demand will stabilize the way it used to be before.
So now, is it not realistic for the new band where the Naira is?
Well, the thing about it is that it may not be realistic, but you know, the thing about it is that it's just about perception. Monetary policy is a 2-monthly thing. It's not so. It's a temporary shock. We don't know what could happen. At the meeting today, Saudi Arabia might be persuaded to cut production, and if that happens, it can help the problem. So you don't take a position that will be too long to correct, because one thing about Nigeria is that, like you see what's happening in the foreign exchange trading now, there's tendency that the trading will quickly move to the upper hand, to the uppermost limit immediately, and to reverse might be a little, difficult. So I think it's a good thing that we have started in this way. It's a show that, because again, another consideration that people are arguing about is that this current CBN governor, his policy stance is that I'm not going to devalue if I have my way. I'm not going to increase interest rates if I have my way. But he has done against what he was supposed to do because of reality. So it shouldn't be too long term, short term. Another 2 months, we have opportunity again to act.
Okay.
If there's need for it.
Well, Mr. Abe, just before we continue this conversation, I'd like you to please respond to this tweet. It's from Idemudia Omoifo. He says, why is the CBN still selling foreign currency to Bureau de Change? Are the banks not enough to meet our forex needs?
Well, the way I may look at it is this way. Nowadays, we're talking of financial inclusion. And one of the ways by which the FX market was democratized was actually the licensing of BDCs. The only difference is that here, the central bank sells foreign exchange to BDCs. However, if we take a look at the fact that what we call a parallel market or black market, in quote, exists along the street, I think one of the major reasons of having to license BDCs then, and even for their existence now, is that whoever cannot have immediate access, to the structure, that you have as banks could approach BDCs, in the neighborhood. And for that reason, what is important is that the supply of FX in the market is not in a particular place. The market exists where buyers and sellers do come together. Therefore, it's a mechanism. So part of the segment of the market, which we have about 4 segments in the market. We have the official markets, which is central bank, the interbank, the BDCs, and then what we call the parallel market, even though outlawed, but it exists. So one of the ways you can actually keep out that market is to empower the BDCs, which the central bank has done, and in which case you can still approach that and then get your FX needs on immediate basis. And so that is one of the reasons why you have that segment of the market. However, what is important is that the differential between those markets must be as narrow as possible, because the wider that the wider the differential in all those markets, then we may have challenges,